Hi guys, welcome to class 21. Um, in this class, we're going to be discussing assignment of income. So this is chapter 12 that I asked you to take a look at. Now, assignment of income is what I call the rubber band doctrine of taxation. There are times when giving away money or property may not be as easy as you would think, at least for tax purposes, because in some cases, an attempt to give or assign income to someone else will not be respected for tax purposes. So then the person who gave or assigned the income will be taxed on it. So it's as though an invisible rubber band snaps the income back to the person who tried to give it away. Now, this is really bad because in real life, that money or property has been given away. So not only will the donor have to pay an income tax on the money that she no longer has control over, but she may also have to pay a gift tax on that money as well. As the text notes, the advantage to a successful assignment of income or property is that the donor will not have to worry about the income or gift taxes. And instead, that transfer will be taxed to the donee, who often may be in a lower income tax bracket than the donor. Now, you will note that this chapter is divided into two parts. There is assignment of income from services and assignment of income from property. With respect to income from services, this income may not be assigned for tax purposes if the income vested even for a second in the person who earned it, or if that person was able to exert any control or direction over where that money went. Now, we see this played out in the case of Lucas versus Earl on page 239. In this case, Mr. Earl directed that half of his salary be paid to his wife. Now, why would he want to do that? Well, note that this is a 1930 case. So back then, joint returns were not authorized. In fact, joint returns were not authorized until 1948. So Mr. Earl was basically trying his own version of a joint return or community property. Now, he probably thought he would cut his tax rate if he directed half of his salary to his wife. So she would be taxed on half and he would be taxed on half, and these would be at lower rates. But the U.S. Supreme Court said that while between Mr. Earl and his employer that might be a valid assignment, it was not a valid assignment for income tax purposes. So not only was Mr. Earl taxed on his whole salary, but the part that he directed to his wife was considered a gift to her. So then he would owe gift taxes on that amount as well, at least to the extent that it exceeds the annual per donee exclusion. Now, note that today, this case would not apply because today we do have joint returns. So why in the case of Lucas versus Earl was this not considered a valid assignment? That was because the salary was earned by Mr. Earl. So it would be treated as received by him and then transferred to his wife. And the same with gifts, etc. The amounts are treated as first being received by Mr. Earl, then given to his wife. The court states that even though these amounts may vest even for a second in Mr. Earl, it is sufficient to tax him on that income. Since it would be taxed as a gift to his wife, then she would not be taxed. In problem 1 on page 250, we have an executive who has a salaried position with High Rolling Corporation in which she earns $80,000 each calendar year. We are asked who is taxed if the executive at the beginning of the year directs that $20,000 of her salary be paid to her aged parents. Well, this is a straight Lucas versus Earl situation. So her entire salary would show up on her W-2 at the end of the year. If this direction of this money to her parents takes place in 2019 or 2020, she would not owe any gift taxes on that amount because this would be considered a joint gift to her parents. So she could then give them up to $30,000 and not have to worry about the gift taxes. That's because the annual per donee exclusion now is $15,000 per donee. So for the two of them together, it would be $30,000. So since she's only directing $20,000 of her salary be paid to her parents, she would not have to worry about the gift tax. Our next case is Commissioner versus Giannini on page 240. Here, Giannini was able to successfully turn down a significant bonus without adverse tax consequences. So this was a successful assignment. He was successful because he refused the money at the first opportunity after discovering the bonus. And he told the board to, I quote, do something worthwhile with this money. Although the service asserted that this was an unsuccessful assignment of the income, the Ninth Circuit disagreed and said that this simple statement, do something worthwhile with this money, was not considered a direction of the money. So Mr. Giannini escaped taxes, both income and gift taxes, on that amount. Now, I want to digress for a minute and tell you a little bit about Amedeo Peter Giannini, also known as AP. He was the first to challenge the unwritten rule that banks should only lend money to people who don't need it. He was born on a small farm in San Jose, California in 1870, the son of Italian immigrants. He was only 7 years old when he saw his father killed in a fight with another man over $1. His mother subsequently remarried, and his new stepfather was in the produce business. AP quit school at the age of 14 to help his stepfather, and he soon impressed his stepfather so much that he was made a partner in the business. AP built his reputation in the produce business by being fair and honest in dealing with people. He did so well that he was able to retire at age 31 by selling his half of the business to his employees. His retirement didn't last long, though, because he was asked by a group of San Francisco businessmen to serve on the board of a small savings and loan that catered to the Italian-American community. In those days, banks only lent money to large businesses and other assorted rich folks. Because of his humble beginnings, AP could relate to the immigrant poor and their needs. He trusted hard-working poor people and wanted to extend credit to them through liberal loan policies. To give the little guy a bank that will do business with him, he said. AP could not convince the other members of his board, though, to give his ideas a try, so he decided to start his own bank. He lined up some investors and started the Bank of Italy in a converted saloon. He even kept one of the bartenders on as an assistant teller. He was the first to offer home mortgages, auto loans, and installment credit, and marketed these services to people who had no experience with credit. He built his business by reaching out to the immigrant poor, even going door to door to explain his services to folks who didn't know anything at all about banks. In the aftermath of the 1906 San Francisco earthquake, a fire threatened his bank, so he borrowed a wagon, collected all his gold, currency, and records, and brought it all to his home. A few days later, and while the other banks in town were still closed, AP set up shop in the midst of the rubble with a plank stretched across a couple of beer barrels serving as his desk. The loans he extended to people, in many cases based on little more than a handshake, contributed greatly to the rebuilding of San Francisco. In 1928, AP purchased Bank of America, an old and very respected institution in New York City, and he consolidated all of his banks under that name. He continued to open branches all over the United States, making Bank of America the first nationwide bank. And by 1945, Bank of America was the largest bank in the United States. As a measure of its success, it withstood the Great Depression, funding large industrial and agricultural interests, as well as California's burgeoning movie industry and even the Golden Gate Bridge. Giannini was a liberal in a very conservative business, but he wasn't just being a nice guy. All of his innovations, like loans to ordinary people and installment payments, were sound business decisions that revolutionized the banking business and generated substantial profits for his shareholders. He also helped large and small businesses that were down on their luck or out of favor. His financial backing of the California wine and movie industries was instrumental in their growth. He was very generous with his employees and instituted profit sharing and stock ownership plans. He understood that sharing profits with his employees would guarantee their loyalty and his success. The man who tried to retire at age 31 was still at the helm when he died in 1949 at the age of 79. His estate was valued at a rather modest $500,000, but this was purely by choice. He could have been a billionaire, but he disdained great wealth, believing it would make him lose touch with the people he wanted to serve. For years, he accepted virtually no pay, and upon being granted a surprise $1.5 million bonus one year, promptly gave it all to the University of California. Rather, his board really gave it to the University of California. Money itch is a bad thing, Giannini once said. I never had that problem. He used most of the money he did make to start foundations that funded scholarships and supported medical and agricultural research. When Giannini died on June 3, 1949, at age 79, hundreds of ordinary people showed up for his funeral. In Revenue Ruling 66-167 on page 246, a taxpayer served as the sole executor of his deceased wife's estate. He decided to take no compensation for this service. The question here was whether the amount that he could have taken constituted taxable income to him and then a gift to the estate for federal income tax purposes, or whether this was a successful renunciation of the compensation. The service said the crucial test is whether the waiver constitutes credible evidence of the taxpayer's intent to render a gratuitous service. The service's general rule is that a formal waiver within 6 months of the initial appointment as a fiduciary will suffice. And since that happened here, the taxpayer will not be taxed on this amount, and it will not be considered a gift to the estate. The service went on to say that the waiver also may be implied if the fiduciary fails to claim compensation at the time of filing of the usual accountings, and all the other facts and circumstances are consistent with a fixed and continuing intention to serve gratuitously. In Revenue Ruling 74-581 on page 248, a law faculty member who rendered services to a clinic for which the faculty member was compensated, the question was whether or not the faculty member would be taxed on that income. The service held that the faculty member was not taxed on this amount when the member turned that compensation over to the law school, because under the faculty member's employment contract, he was required to turn over to the law school any compensation received as a result of his clinical duties. Therefore, legally, that amount never vested in the faculty member because his agreement with the law school predated the earning of the compensation. Let's go back to the problems on page 250 and look at problem B. Who is taxed if the executive at the beginning of the year directs that $20,000 of her salary be paid to any charity the board of directors of High Rolling selects, an executive is not a member of the board. Well, that's unclear. The IRS might argue that the salary is taxable to the executive and that this is not within the facts of Giannini, because there is some degree of direction on the executive's part in requiring that the property go to charity, as opposed to Giannini's general statement, do something worthwhile with the money. The IRS appears to take a narrow view of Giannini. In Revenue Ruling 79-121, a taxpayer was entitled to an honorarium for speaking to a professional society. The taxpayer requested that the charity donate the honorarium to one of 5 charities that he listed. The service said he was taxable on the honorarium and then could take a charitable deduction under Section 170. However, the charitable deduction is a below-the-line deduction. That is, it's an itemized deduction. So he may not be able to take it, and even if he could, it's not always a wash. As we will talk about later, under the Tax Cut and Jobs Act of 2017, it's become more difficult than before to be able to take itemized deductions. Now, in the alternative, the facts of this problem may fit within those of Giannini. If so, then income from future services may be successfully assigned, or more accurately, timely rejected. In order to have a successful assignment, Giannini requires the taxpayer to disclaim, both prior to earning the income and without naming a specific recipient. Arguably, directing the payment to any charity the board of directors selects is the same as suggesting that the corporation do something worthwhile with the money. Now, if the executive was a member of the board, it's arguable that she could indirectly determine the recipient, therefore, in effect, assigning that income. If so, then it would be taxable to the executive. Let's take a look at problem C, which is the same as B, except that executive now makes the same request with respect to a $10,000 year-end bonus, which the corporation has announced toward the end of the year, based on services rendered during the year. Normally, for Giannini to apply, the disclaimer must occur prior to rendering the services. But even if this payment is a bonus for services previously rendered by the executive, it was not contracted for by her, so therefore it's not part of her normal salary. Thus, she should be able to disclaim the bonus when she is first aware of her right to it. But if she customarily received a bonus, and therefore should have anticipated it, even though she might not know the exact amount, she then probably would have to disclaim prior to rendering services in order to qualify for the Giannini exception. In D, who is taxed if the executive, in her corporate role, gives a series of lectures on corporate finance at a local business school, and pursuant to her contract with High Rolling, turns her $1,000 honorarium over to the corporation. Well, this seems to be within the facts of Revenue Ruling 74-581. Thus, the corporation would be taxed because the executive is acting as an agent of the corporation, since she is contractually bound to turn that money over to the corporation. Now, the second part of this chapter deals with income from property. The general rule here is that such income, which is often referred to as fruit, cannot be given away tax-free without conveying the underlying property, known by the metaphor tree. So, for instance, under Helfering versus Horst, you cannot give away interest from bonds without being taxed on it unless you also give away the underlying bond. On page 252 of the casebook, the court states, the power to dispose of income is the equivalent of ownership of it. So if you retain control of the underlying property, then you're going to be taxable on the income. An issue that arises here is timing. So when is the donor taxed? In Helfering versus Horst, the court held that the interest on the bonds was taxable to the owner of the bond as that interest was paid to the donee, and then would be treated as a gift at that time. An exception to this general fruit and tree rule is where the income interest constitutes the full interest owned by the transferor. This was the situation in Blair versus Commissioner on page 254. Mr. Blair owned an income interest in a trust, which he then transferred to his children. The U.S. Supreme Court held that since that was the only interest that he owned in that trust, and since he had conveyed his entire interest to his children, this was a valid assignment, and the children, not Mr. Blair, would be taxed on the income. So in other words, Mr. Blair only owned the fruit. He did not own the underlying tree. So the fruit was all that he had to convey. Let's take a look at the problems on 269 and 270. We have a father who owns some land that he purchased several years ago for $80,000. It has appreciated, so it has a current fair market value of $90,000. He leases this land on a 10-year lease and is paid $6,000 of rent each year. That is paid semi-annually, April 1st and October 1st, $3,000 each payment for the prior 6 months' use of the land. What tax consequences do father and daughter in the following alternative situations? First, in A, on April 2nd of the current year, father assigns daughter all the future rental payments. Well, the father will be taxed because he retains the tree, that is the underlying land, and he's assigning only the fruit, that is the rents from that tree. This is the Horst case. However, at the time of the assignment, no rent was due, so the father is not taxable until the daughter receives the rental income. In B, on April 2nd, father gives daughter the land with the right to all the future rental payments. Now the father has conveyed the underlying tree, so the daughter will be taxed. In C, on April 2nd, father gives daughter a 1/2 interest in the land and the right to all the future rental payments. In that case, half the rents will be taxed to the father and half will be taxed to the daughter. The taxable event will occur when the rents are paid to the daughter, and this is under the authority of both Horst and Blair. In D, father owns an income interest in a trust which owns the land. And on April 2nd, father gives his income interest, that is the right to the succeeding rental payments, to his daughter. Well, this is a straight Blair situation. The daughter will be taxed because the father has conveyed his entire interest. He only had an interest in the fruit and none in the tree. In E, on December 31st, father gives daughter the land with the right to all the future rental payments. Again, this is a Blair situation. However, this problem raises the question of what is called ripe fruit. So another exception to the assignment of income doctrine is where the property is conveyed with ripe fruit. So when the father transfers the property to the daughter on December 31st, half of the rent has accrued and is considered ripe fruit. So on April 1st, when the rent is paid, half of that rent, which is $1,500, will be taxed to the father, and the other half, the other $1,500, will be taxed to the daughter. After that, all the rental payments will be taxed to the daughter. Now, let's go back to the cases. In a state of Stranahan versus Commissioner, a father assigned to his son anticipated stock dividends, for which the son paid fair market value. The father had a large interest deduction that he wanted to take full advantage of, and so that's why he sold the dividends to his son. The father reported the amount received from his son as ordinary income, and the son then reported the dividend as ordinary income to the extent that it exceeded his basis, that is, the amount he had paid for it. The Sixth Circuit held that this was an arm's length transaction, and therefore it was a valid assignment. So this again is an exception to the transfer of fruit being taxed to the transferor. Where anticipated income is sold for valuable consideration in an arm's length bona fide transaction, that assignment is successful and the income will then be taxed to the buyer. Let's go back to the problems for a bit and take a look at problem F. On April 2nd, father sells daughter the right to the 2 succeeding rental payments for $5,000, their fair market value as of the time of the sale. So the father will be taxed on the $5,000 of income under Stranahan. This is a sale for adequate and full consideration. It was not a sham, even though there was ripe fruit. The daughter will then be taxed on the rental payments as they're paid, but she may recover her adjusted basis of $2,500 per payment, leaving her with $1,000 in total of ordinary income. Now, let's go back to the cases again. So in the next case, which is the case of Susie Salvatore, in Salvatore versus Commissioner, page 260, the taxpayer, Mrs. Salvatore, had inherited property from her late husband. She negotiated with Texaco to sell this property, and shortly before that sale occurred, she deeded the property to her children as a gift. It was held that the sale proceeds constituted an anticipatory assignment of income that was taxed to Mrs. Salvatore, even though those proceeds went directly to her children. So, in other words, she had negotiated the sale, or the negotiations had been done while she owned the property. So the terms of the sale and the amount of the profits had already been determined before she transferred that property to her children. Thus, this is treated as a sale by Mrs. Salvatore with a transfer of the proceeds to her children. That means that she is then taxed on the proceeds, and then the deemed transfers to the children are considered gifts. One thing I want to mention here, if you look on page 262, near the bottom of the page, the court refers to protective claims for refund. Now, what's going on there is that these children had already paid the taxes on the proceeds they received from the sale. If Mrs. Salvatore lost her case, which she ultimately did, that would mean that the children would then be entitled to refunds of the amounts of tax they had paid. But by the time a final decision is likely to be rendered, the statute of limitations will probably have expired. So that's why they're now filing protective claims for refund to preserve their right to a refund later on. Now, back to the problems. Let's take a look at G. On April 2nd, father sells the land and directs that the $90,000 sale price be paid to his daughter. Under Susie Salvatore, this constitutes ripe fruit, so that the father will be taxed because he completed the sale. So the appreciation in the property is realized prior to the sale, but would be recognized after the sale. In H, prior to April 2nd, father negotiates the above sale, and on April 2nd, he transfers the land to his daughter, who transfers the land to a buyer, who then pays daughter the $90,000. Negotiations may have proceeded to the point that although the sale is not complete, the agreement may be so firmed up that it will be taxed as completed. So the father may be taxed even though there's no binding contract that had been signed, and the daughter then carries out the sale. Going down to problem 2. We are asked to determine who is taxed on the lottery winnings if, in A, Lucky purchases a lottery ticket and gives it to child prior to the lottery winner being announced. The ticket turns out to be the winning lottery ticket. So here, child is taxed because the ticket is property transferred prior to any increase in value. In B, same as A, except that Lucky's gift occurs after the lottery winner is announced. Well, here Lucky will be taxed because now the winnings constitute ripe fruit. In C, Lucky wins the lottery but properly elects under Section 451H to be taxed on the lottery winnings in the form of an annuity each year for 20 years. After 2 years of annuity payments, Lucky gives the remaining 18 years of payments to the child. So here's the deal. If you win a cash prize, that can be the lottery, a contest, a jackpot, a game, etc., and the terms of that prize allow you to choose between a lump sum amount payable immediately or an annuity, and you choose the annuity, you will then be taxed on the present value of the entire winnings. Now that could certainly take the joy out of winning, because then you more than likely would have to borrow money to pay that tax liability. Section 451J. Now, I know the problem refers to 451H, but that's now been changed to 451J, so please make a note of that. 451J provides some relief from that. So if you win a cash prize that does not relate to any past services that you might have rendered, and you elect the annuity not later than 60 days after you win, and that annuity is payable over at least 10 years, then the amount that would normally be included in income, which would be the amount of the present value of the winnings, so it would be a discounted value for the time value of money, that would be ignored, and you will then be taxed only as you receive each annuity payment. So if Lucky meets the requirements of 451J, she would then be taxed only as she receives each payment under the annuity. Now, when Lucky gives the remaining annuity to the child, who's going to be taxed? Well, that would be Lucky, who in this case is not so lucky, because the remaining payments constitute ripe fruit, since Lucky was the winner. Now, if you're really thinking about this, you might wonder, why is this not like Blair? Because isn't Lucky transferring her entire interest? She only has an interest in the income, and she's transferring that entire interest to the child. So why is she then taxed on it? Why is this not like Blair? Well, Blair involved income from a trust that was unearned at the time of the assignment, and in fact might never be earned, whereas Lucky's income has been realized. So this would not be a successful assignment. Remember, it's only because of the special rule under 451J that Lucky was not taxed on the whole thing earlier. So the moral is that you cannot escape tax on lottery winnings unless you disclaim those winnings or receive no benefit from them. In 3, we have an inventor who develops a new electric switch which she patents, who is taxed on the proceeds of its subsequent sale if, in A, the patent is transferred gratuitously to inventor's son who sells it to a buyer. Well, the transfer of a patent is treated like the transfer of property, despite strong elements of personal services in developing the patent. So the transfer to the son will be effective in assigning to the son the income from the sale. In B, the inventor transfers all her interest in the patent to the buyer for a royalty contract, and then transfers that contract gratuitously to her son prior to receiving any of the royalties. Somewhat surprisingly, the courts have held that assignment of such a royalty contract is an assignment of property. So the son would be taxed on the royalties as they are received. An argument could be made that the income is ripe fruit under Susi Salvatori, although courts with apparent reluctance equate the transfer of a royalty contract to the transfer of the income-producing property, that is, the patent itself. Now, going back to the revenue ruling 69-102 on page 264. In this ruling, a taxpayer sold an unencumbered endowment life insurance contract to a charitable organization for the amount of his basis, and he then donated to the organization the appreciation in the contract. He also gave an unencumbered annuity contract to his son as a gift. In the year after these transfers, both contracts matured and were cashed in by the donees. The question then was, what, if any, tax consequences did the donor have? Well, first, an endowment insurance policy is a policy that couples term life insurance with a savings program. So you make contributions, that is, you pay premiums, and you then receive a guaranteed payout when that policy matures. If you should die before the policy matures, your beneficiary will receive the payout as a death benefit. The endowment policy offers a risk-free guaranteed return on a guaranteed date, as long as you continue to pay those premiums. But the safer the investment, the lower the return. Also, the accumulation on the contract is taxable if it's not paid as a death benefit. So if it's paid during life, it's going to be taxable. Usually these are not very good investments because a portion of your investment will be going toward the life insurance part of the contract. The service held, not surprisingly, that the donor was taxed on the ripe fruit because the power to dispose of income is the equivalent of ownership of it. There was also a question of the timing of the taxation. The service states that a gift of income does not operate to accelerate the year of taxability. So the donor will be taxed in the year following the year of the transfer when those contracts mature and are then cashed in. So the cash surrender value of the contracts at the time of the transfer, less the donor's adjusted basis, will then constitute ordinary income to him in that following year. Then the fair market value of the endowment contract, less the amount he received from the charity, will constitute the charitable deduction. So that ends the material for this class. If you have any questions, be sure to email or call and let me know. And then I'll set up an email with the entire class and address the questions. So for our next class, what we're going to do there is we're going to skip chapter 13 altogether. We're not going to talk about income producing entities. Instead, we're going to go over to chapter 14. We're going to start talking about business deductions, and we'll start with the workhorse provision, section 162. So I would like you to take a look at pages 309 to 343 in chapter 14 and do the problems within that material. And so I will see you in the next class. Everybody stay safe.